All right, so we're going to do a market update here. I'm going to try to go through our indicators as well as give you some insight on some other things we don't often talk about, but this is a very unique market. So we'll be talking about a special offer later on, but I'll come back to that later. So as most of you know, we follow four main indicators, the main one being the chart of the S&P, because that's really what the market is. If your indicators are saying buy and that's going down, your indicators are wrong. Also, we'll look at call ratios. We'll look at market breadth, where we have a bit of an option-oriented twist there. And then there's a lot of stuff going on with VIX right now, some very potentially profitable things there as well. So I figured out this morning how to make a slide flash, but I'm making this one flash because this is really the most important thing I can stress today, is that oversold does not mean buy. So this market is very oversold. It was probably oversold 2 weeks ago. Now it's really oversold, but we're still not getting buy signals. We have one. So the market can continue to go down a long time. I mean, I think that's what John Maynard Keynes meant when he said the market can stay irrational for longer than you can remain solvent. So, this is a very important concept. Oversold does not mean buy. The companion to that is overbought does not mean sell. We don't really have anything that's overbought right now, but maybe someday. In any case, here's the long-term chart. So you can see how badly we've broken down here. We're down 21% in 37 trading days. That's a lot. We had, while this bull market was going on from beginning October of 22, down in here we had a 10% correction. Then last year we had a 9% correction. Then we went into this trading range up top here, and it was a bit deceiving. First, we made new highs. That was good in November. Then we came down. Looked like we were breaking, but no, popped back in the trading range. It looked like we were breaking out a couple of times, but no, back in the trading range. And then finally, here in mid to late February, we broke out of the trading range on the downside. So that was the first big negative. This is the 200-day moving average. You can see now that it's curled over and starting to head lower. That's not a good sign either. That's usually a sign of a bear market. And we've made lower highs and lower lows. This downtrend line right here is showing you, connecting the two highs. That's pretty steep. I would assume that, later on we'll try to come up here and make another rally, and a downtrend line might be not quite so steep, but still, it's a bear market. And, it was at first a bearish market, but now it's a real bear market. And I don't go by that 20% thing. That means nothing to me, but I'm just going by a pattern of lower highs and lower lows. And that's what we have right now. So until that pattern is broken, we're still in this trend. And to that end, you can see that the second high there is at 5,800, roughly 5,800. And so where's my right here? So that's, if we got above 5,800, that would break the pattern of lower highs and lower lows and be positive. Here's a 1-year chart. I'm just pointing out where those false breakouts occurred from that trading range. We had the first oversold rally. We got oversold there right in here. We had an oversold rally. It ran into, this is the 20-day moving average. It ran into the 20-day and the 200-day pretty much at the same time. It couldn't handle that, and it fell back. We had two big gaps down on the chart. We filled the first gap, but not the second. So we may be, heading over here to fill this gap and still would be within, the downtrend line, or even if we filled it a little bit over here, it would still be a lower but less steep downtrend line. So again, just another possible target there. Looks like about 5,600 or so. So just to kind of summarize that, there were a bunch of support levels. They were pretty much meaningless. Now we bottomed around 4,850 to 4,900. I'm going to back up one slide. You can see that bottom horizontal line. There was a low at 49.50 last April off a minor correction. I don't really think that was playing a big role, but that's where where we sort of bottomed out this time too, so that counts. And so that support area is around 48.50 to 49.50, something like that. Oversold rallies fail at the declining 20-day moving average. So right now the 20-day moving average is a little bit above 5,500. Sometimes you overshoot that. And then, as I said before, if we were to go above 5,800, that would be bullish, and that would be a game changer. To me, that would, turn a S&P chart at least back to neutral from bearish. So we also draw modified Bollinger Bands on the charts. I'm sure if you've been a subscriber, you've seen these. When John Bollinger invented Bollinger Bands, he used as a definition of volatility, realized volatility, the standard deviation of closing prices. That's not really what the math guys use, like Black-Scholes. They use the standard deviation of daily percentage price changes. So we do that too, because our models need to have realized volatility and be in line with the implied volatility as computed by the Black-Scholes model. So we will look for it to move outside this 4 standard deviation band and back in again. So here's a chart going back about a year, and let's see if I can find there we go. So this is the 4 standard deviation band right there. And then the 3 standard deviation band is just inside it there. So you can see at that time we moved out and then back in. That's a sell signal. And the target is for us to go down and hit the bottom, the -4 standard deviation band, which we did. Then move back inside. That gave us a buy signal. So back here we had a frequency of signals. That buy signal lasts for a long time. And you can see that we never did get up to the 4 standard deviation band. It came close a few times, but never really did. So that buy signal was, well, we had positions, we rolled them up several times. That was a successful buy signal. But here, about 3 weeks ago, we fell below the 4 standard deviation band, went back inside, it started a rally, and boom, hit that 20-day moving average and the 200-day moving average, and that was the end of that. We fell back and closed back below the 4 standard deviation band right there. That stopped that signal out for a loss. That's why it's in blue. Blue is the loss, red is gain in this chart. And now we've rallied strongly this past Wednesday, and we rolled down here at the very low. We were this is the -4 standard deviation band right there. You can see we were below it for several days. Then we popped on the 1 day all the way up to here, closing about there. So I put this small green B on the chart because that's the predecessor, potential predecessor to a buy signal. That's what we call the classic buy signal when we close inside the 3 standard deviation band. However, there has to be some more progress beyond that. So you can see that band that day topped out right here. So we need to see the market move above that level in order to generate another one of these McMillan volatility band buy signals. So right now we're awaiting that. There's no guarantee that's going to happen. But the way we stated in the newsletter yesterday, we want to see the market trade up to 55.75 at least in order to generate that new buy signal. So that would be a buy signal if we get to 55.75. I mean, we're at 53, whatever, 75 or so right now. 53.63. Right at 53.75 yesterday. So it's still a couple hundred more points on the upside just to generate that buy signal. That's what happens in an oversold market. Things get very oversold, and then you think, well, with these big rallies, everything's good, but it's really not. The big rallies just come with the territory, and we'll talk more about some of those large rallies later. We have a subscription service, by the way, to this McMillan volatility band. You can draw those lines on any chart. So this is what it looks like. It runs through TradingView. That's the current chart. I just pulled it off this morning. And you can see that the system, here's that long buy signal that I was showing you before, the sell signal before that, then the failed buy signal that we just had. And now, if you look closely, this bar right there where we when we moved above the -3 standard deviation band, that's the -3 right there, but we moved above it, it's in blue and not black like the other ones are. So a blue bar indicates a classic buy signal that could be the predecessor to the next real buy signal. As soon as the real buy signal appears, that green arrow or green triangle will appear on these charts. I just grabbed another one, NVIDIA, for example, and it also gave a failed buy signal in March, and now it's come down, went to below the -4 standard deviation band, came back inside, generated that same blue line, but now it needs to climb up above there in order to generate the buy signal. So I believe it's somewhere above 115 is going to have to get to generate the next buy signal. The service that we provide, the subscription service, has exact numbers on there, and it tells you every day which ones could possibly be setting up for buy signals. To describe how oversold this market is, that service today, the potential buy signal list is 8 pages long. So there's a lot of oversold stuff out there right now. Let's get back over here. So, well, let's move on to put-call ratios. Put-call ratios were invented as a contrary indicator by Marty Zweig back in the 1950s when he was getting option volume out of the ads that the put-call dealers ran in Barron's every week, every Sunday. So the theory is too much put buying. He observed this, and it's still true. Too much put buying means everybody's pessimistic and you want to be bullish on the market. That's the contrary theory. And too much call buying means everybody's bullish and you want to be bearish on the market. So we looked at a variety of things. You want to measure these, you want to quantify what too much means. So there's two put-call ratios that we use. The first was a standard where we just use the volume. We take the volume of puts traded on any particular entity that day, divide by the volume of the calls traded, and that's your put-call ratio. So you can see that since puts are in the numerator of that fraction, heavy put buying will make the ratio go higher. But when you're likely to have heavy put buying, well, that's when the stock is going down. So obviously they move in opposite directions to each other. Similarly, heavy call buying is in the denominator. That heavy call buying increases the denominator of a fraction. The fraction gets lower, so the ratio will be going lower while there's heavy call buying. So as a result, if you look at a put call ratio chart, and we post these on our website in an area called the strategy zone, and it's a fairly inexpensive area to look at data. We put the stock price chart and the put call ratio chart on each chart because one doesn't do you any good without the other. You want to see this inverse pattern. And so what the significant points here are when we find a local minimum on the put call ratio chart, that's a sell signal for the stock. And when we find a local maximum on the put call ratio chart, that's a buy signal for the stock. So that's the theory. This is not a current chart, but on top is the S&P 500 index. And on the bottom is the equity-only put-call ratio. That's all stock options that trade, millions of them. But you can see the inverse symmetry here, and that's why we use the equity-only put-call ratio to predict the broad stock market. So here we are. Here's today's equity-only put-call ratio using all stock options that trade. And you can see that, we had a local minimum here in February, an excellent sell signal. Back here, we had a local maximum. That was a good buy signal. This one was not so good, but was quickly reversed. And so where are we right now? So this just yesterday moved down a little bit. Now we have a computer program that analyzes these charts. It knows what's coming off. These are 21-day moving averages. I used a Fibonacci number just in case there's anything to Fibonacci. And so this moved down for one day, but the put call ratio with the program knows what's coming off the put call ratio from 21 days ago. And it kind of knows what's going to come on tomorrow because it just looks at the last few days, see where the ratios have been. They've been pretty high the last few days. So the computer program is saying, not yet. It's saying it thinks that's going to go higher. Right now, in fact, it's only giving that about a 20% chance of being a buy signal right there. as we stand. So even though we rallied and we got that little, looks like maybe a buy signal, and interesting to note that that didn't happen till yesterday. It didn't happen when we bottomed out, last Monday or Tuesday. In any case, so keep that in mind. This is a standard put call ratio chart. It's not turned to a buy signal yet. Now, as computers came along, we were able to calculate another put call ratio, which I call the dollar weighted put call ratio, or just the weighted put call ratio. And now we look at the dollars being spent on bulls puts versus the dollars being spent on calls. And so, same sort of thing, but now this turns out to be a little more accurate, I think. The signals often occur about the same time, they're just more extreme. So here's that chart. And you can see now that on this chart, we're already well above where we were last year when we got buy signals, decent buy signals back there. So the absolute level of the ratio is not what's important. It's whether it's rolling over and trending down or rolling over and trending up. Now this one, you can see here in about a month ago, when the market had that little oversold rally that we talked about before, this one looked like it rolled over to a buy signal. In fact, even the computer analysis programs agreed that that was a buy signal. But since the standard was not the one we just looked at, the standard ratio was not yet on a buy signal, we did not issue a buy signal based on this. So now the same thing's happening again. This topped out a couple of days ago, and this looks like it might be a buy signal there. In other words, a local maximum. But again, the standard ratio is not agreeing. So I want to see them both agree before I say that, contrary opinion has reached a point where it's too much pessimism. So right now, this is a little bit encouraged. The standard ratio is really not. I would say we're in oversold territory because it's so high on its chart, but that's only a 1-year chart. If we go back a little farther, this is 10 years now on the standard ratio. So this is what we just saw here about the last year or so, is what the chart I showed you before is. And you can see the standard ratio is here, and that's where I said not yet. You look at where it's been in the past. This was the bottom of the bear market in 2022. This was the pandemic, and back in here. And you can see from the pandemic, we went from very high, very pessimistic reading, very high put call ratios, all the way down to here very low. And we stayed there for a long time. So that was extreme optimism. This year, I just think we had optimism, not necessarily extreme optimism, but it doesn't really make any difference. The point on this chart is that even though the ratio is higher than it's been at any time in the last year, it's not that high. I mean, it could go a lot higher. So just to say there's a lot of pessimism in the market is not really a justifiable statement from this chart. What about the weighted ratio? So I don't know what was going on back there in 2001, why it went so high, but we did have some pretty heavy selling back in there, the end of that bull market and everything. But then it did spike up during the financial crisis. Then we got this chart, this ratio, the weighted ratio, doesn't really go down much lower than about this level. That's 50. That means $50 are being spent on puts for every $100 being spent on calls. Doesn't really get much lower than that. And then the bear market brought the ratios up, fairly high in here. And here's where we are right now. So that ratio I showed you, it's quite a bit higher than the ones we saw in that chart, and that chart is only taking in about this part of data right there. But you can see it gets much higher at these other bottoms. So again, yes, pessimism, extreme pessimism, probably not. So, if it rolls over, gives a buy signal, we'll act on it. But I'm not saying that it's at the kind of pessimism you would see normally at the end of a bear market. It's not there yet. So what do we buy when we get these signals, a put call ratio signal or MVB buy signal or something? So we generally buy SPY options, and we'll use them with a delta of, a fairly decent delta of 50, 60, 70, something like that. The delta of call option range is between 0 and 1. I don't want to buy something with too small of a delta because you're not going to benefit. You could actually have a situation where you're right about the stock or the index and wrong about your option. That's not any fun at all. So the higher the delta of the call, the better it's going to respond to movements in the underlying. So as I said, we'll buy a slightly in the money option, with a delta of 70 or higher. Even if we buy an at the money option on a longer term trade, say like a put call ratio trade with only a few per year, we'll still buy an at the money option, still have a delta of 55 on a call. So on TV, they spread every option trade they do, which is not really what you should be doing. When you spread, by spread I mean this. So let's say you're bullish, so you buy a call here, and but spreading, you sell a call over here, so that cuts off your profit potential if your stock rallies up to this point. Well, that's not good. I mean, in my career, my best trades have been, letting profits run. An easy way to let profits run is just be long a call and keep rolling it up as it goes higher and higher and higher, so you're not completely worried about a reversal in price, and you can make some pretty decent money that way, but not if you cut off your profit potential. So the only time you should be cutting off, it makes sense statistically or mathematically, is when the options are expensive. Well, we certainly have expensive options right now. So right now, spreading is what we're doing with SPY and any of the positions we're going to take. But, just to prove this other point, the proponents of always spreading say, well, you're risking less, but you're not risking less. Your broker's going to ask you to fully pay for that call spread or fully pay for your call. So you're risking 100% of your investment in both cases. You're not really risking less. Dollars, you can control the dollars instead of buying, let's say, 5 bull spreads, you buy 4 calls or something, whatever. And then you have the potential for this to happen. But what if you do the spread? So there are ways to mitigate the negative effects of spreading. The first is to widen the difference in the strikes in that spread. So right now, because the market is so volatile, we're spreading SPY calls 20 to 25 points wide, and puts much wider because out of the money puts are more expensive than out of the money calls. So in a put spread, we'd be spreading 40 to 50 points wide. And if you've been following our newsletter, our newsletters, that that's what we're doing. The second thing you can do is roll if the short strike is hit. But let's take a look at what that means. So let's say S&P or SPY right now is around 540. Feels like it should be a lot lower, but that's where it is. And so let's say we're going to buy a position on Monday morning, a bullish position. You buy the 540 call and sell the 565 call, 25 points wide. So normally on a 25 point wide spread, you wouldn't be paying anywhere near even half of that. But the way things are today, if that May 540 call and at the money call and SPY for May, it's going to cost you about 22 points. You're going to get about 8 for selling the other call. So you're buying 22, you're paying 22, and you're selling. You're buying this at 22, you're selling this at 8, you're paying 14 net. The best you can do here is make 25. So paying 14 for a max of 25 is really not all that great. But you may not be wanting to risk more than $1,400 on this trade. I don't know, it depends. But if you even use a wider one, say 540 to 575, then you would be buying again the call at 22, and you sell that call at 5, so that you'd be paying 17 for a max of 35. About half. So you could double your money. That's better, but really not all that great. You'll see in a second when we look at puts, they're actually much better than the calls. Anyway, so what do I mean if the short strike is this? So let's go back to that first example. SPY was at 540. We did the 540, 565 spread. Let's say your timing was good SPY rallies right up to 565. So at 565, you're not going to have a whole lot of potential left in this spread. You know, here this was the spread. This is 565. This was 540. So, but now your profit potential is up in here somewhere. Yeah, you can make a little bit more. There's some time value, but you're pretty much, you know, done. So to recreate profit potential, sell that spread. So sell the spread you own, and instead buy a new one, moving everything up 25 points. And so now that new spread has a chance to expand another 25 points. Meanwhile, you've taken a credit out of the trade already. Whatever you bought initially, whatever you paid for, it's going to be higher now that SPY's up at 565. So this is a strategy we use when options are expensive and you want to continue to stay in the spreads. You can do the same thing with puts. Suppose you're bearish on a Monday morning. You buy the May 540 put. That costs 19. The call costs 22, and that's just caused by interest rates being where they are right now. Here we're going to sell an option that's 50 points out of the money. So we're going to sell the 490 put for 7. So now we're paying 12, 19 minus 7, for the possibility to max out 50. Now that's more like it. I mean, that, 4 to 1, that I can get behind. And so in this case, if SPY traded down to 490, you take your profit on that spread and you set up a new spread with strikes 50 points lower on both sides. So this past week, bear spreads, we were rolling them down every time they hit the strikes, and that was a lot of times for some of them. So this is the strategy that we will be using or have been using when we've got sell signals, which we've had plenty of in the last couple of weeks. So I didn't update this section, sorry. We're going to have to skip this because I was going to mean to come back to this, but these are charts a couple of weeks old. I will say this, I am going to be looking at the put-call ratio charts over the weekend. So maybe what I can do is when I do that, I'll insert charts in here, and when you look at the PDF that gets emailed to you or posted, you can see some individual charts, but I don't have any right now. And in fact, this week when I looked, there weren't that many. The market is just a little bit too insane right now for put-call ratio signals on individual stocks, but I'll go through them this week and I'll try to update that. All right, the next thing we look at is market breadth. Breadth you can do two things with it. You can keep a running total, advances minus declines. We do that. And then you can also keep an oscillator, which is our oscillator is today's value is 90% of yesterday's oscillator value, plus 10% of the difference today between advances and declines. Now, here it becomes a little bit of a question of what data you're using. So New York Stock Exchange data is the common thing that's used, advances minus decline. But I will tell you that there are a lot of things on the New York Stock Exchange that are not stocks, interest rate related things that can wander off and have a different, advanced decline structure than stocks do. So we were looking, well, this has now been like 25 years ago, we were looking for, a good stocks only data set, and it turned out we had one right under our nose that's all stocks that have listed options. So we use that as our stocks only data set. I mean, I know you can't compute that at home on your own, but we put out that data in our daily publications and in our weekly publications in case you want to keep it and just build your own database of that stocks only advances declines. So this is the oscillator. So this goes back here about six and a half years to 2018. The green areas are where we've been oversold. The red areas where we've been overbought. The S&P chart is on the top here. And you can see that, oversold in the way on the left side of the chart, we weren't that oversold too often. Occasionally, I mean, this was that really bad Christmas, December 2018, very ugly. This was the pandemic, pretty big sell-off. But then we got into an actual bear market, and you can see how often it was oversold then during a bear market. Then the bear market went away. But here's where we are right now. So even after, well, we're pretty much at the low, I think. Oh, well, now we popped up a little bit, so I can't quite read where the last piece of data is. We're right in there somewhere. So we're very oversold. And remember my flashing slide, oversold does not mean buy. So we're not buying yet based on that indicator. We buy when it stops being oversold. When it gets up to here, then it would generate a buy signal. So I don't know where that's going to happen, but you can see from some of these other ones that when it did finally get up there and generate that buy signal, you know, yeah, you didn't hit the exact bottom, but I'm trying not to get caught in front of a bearish freight train. I want to make sure we've actually turned the corner on some of these. So that's those. You can see those other cases back there on the left side of the chart. When they stop being oversold, there's still a lot of rally left in the market. So that's how we'll be approaching this one as well. And you know, the breadth oscillators have tried to get buy signals when they fell back into oversold territory. That's the same as reverting to a sell signal. Again, oversold does not mean buy. So these are very short-term indicators that have been whipsaws. We try to use 2 and 3 day confirmations on these and things just to calm down the whipsaws. So the next time he gives a buy signal, hopefully would be a good buy signal, but you know, nothing is guaranteed with any of these, especially with the breadth oscillators. So another thing we look at is cumulative breadth, cumulative volume breadth. We just keep the advancing volume minus the advancing declining volume every day, and that sometimes at bear market or bull market tops shows a big divergence. This time, no divergence. So no help from that indicator. But that doesn't mean, you know, every bear market does not start with a divergence from this indicator. So we didn't have one, but doesn't preclude the fact that we're in a bear market. So new highs versus new lows on the New York Stock Exchange is another thing we look at. This was in a sell signal that had been generated a little bit earlier, and then we on 2 days here in mid-March, we had more new highs than new lows for 2 days in a row. That stopped out the sell signal. So at that point, the indicator went back to neutral. But then by March 28th and March 31st, we had not only more new lows than new highs, but we had more than 100 new lows on each day of those. And that was a new sell signal as of March 31st. So this thing's been on a sell signal since March 31st. Whatever bear spread we had has been rolled down. And it's not going to revert anytime soon. The way to get out of this is for new highs to outnumber new lows for 2 days in a row. I really don't know how that's going to happen. I mean, we did have yesterday, this is current, you can see at the bottom of the chart there were 19 new highs yesterday. I mean, I don't think there were any stocks I was looking at, but whatever, there were 19 new highs. You see that last Monday and Tuesday there was only one new high in the entire New York Stock Exchange each day. So this is going to stay bearish for a while, but you know, sometimes when it rolls, the bottom is already in. So that's why we roll our spreads down, take those credits out, things like that. This though is still on a sell signal. So now we get the VIX. Very interesting. You know, there's periods of time when people don't like VIX. They say it's not doing whatever it's supposed to be doing. It's just a calculation, so of course it's doing what it's supposed to be doing. But you know, people want to use it all the time as a fear indicator or whatever. But in any case, there's two important things about VIX. First of all, it should be trending opposite to the way the stock market is going. And secondly, if you get spike peaks on VIX, those are usually like extreme fear things, and that when they go away, when it peaks and goes up, it comes back down, the fear is gone, and that's a buy signal for the market. So we follow both of those things very closely. If VIX gets very low, obviously that's not the case now, but it was, you know, back in January or whatever, even last fall. That's not bearish in and of itself. It's not really bearish until it begins to rise, and I'll show you how that works on the next slide. So here's the current VIX chart. First of all, we had a spike last August when there was just like a panic I can't even remember what it was about now. It spiked all the way up to 65 and right back down again. That was a very good buy signal for the stock market. But this time now, we spiked up and all the way up here to 60 last week. And now that same day, in fact, we closed well below it. Where's my, I'm trying to find my, oh, there it is. Sorry. So we spiked up here to just above 60 and then spiked right back down. And so that is a buy signal. It's green on the chart, meaning it's currently in place. This is the only buy signal we have, confirmed buy signal. And you can see the red Bs are successful trades, the blue Bs are not. And there's one. The trade lasts for 22 days. So if we get an overlapping signal within 22 days, we don't trade it. We put it on the chart, but it's not really a tradable thing. So this orange B here was within 22 days of that red B there. So we didn't really trade it, but it was a little spike. So the spikes, there's been a lot of them. I really think almost too many. But we trade them as if you look at the Option Strategist newsletter, if you've done all the trades that we did in there, you've made thousands of dollars from this indicator. So even though sometimes it doesn't work, we still keep at it. So those are the spike peaks. So what about the trend? So at the bottom there is a pink circle. And we define the trend of VIX as being when the 20-day moving average and VIX itself are both on the same side of the 200-day. That's a trend. So right here, the 20-day crossed above the 200-day, and VIX was already above. So that generated a sell signal on February 18th. That sell signal is still in place, and it's going to stay in place until VIX falls all the way back and closes below its 20-day moving average, its 200-day moving average for 2 days. You can see it almost got stopped out right there. Well, that would have been a killer. It would have gone right back into effect, a few days later, but it didn't. It didn't get stopped out, and so that trend is still there. Now, again, positions that we had in line with that have been rolled. So even though we have both a buy signal and a sell signal from the VIX chart right now, that they can work independently. The buy signals only last for 22 days. The trend can go on as long as it wants to. So I'm just sort of repeating that. We monitor these. They're mentioned in the newsletter every day, so on the daily letters anyways. So you can't trade VIX, but you can trade VIX futures and VIX options, and the options are options on the futures, even though not specifically, but they're the underlying for the options that trade in the CBOE is really the VIX futures that trade on the CBOE futures exchange. So in a normal course of events, the near-term future is going to be the cheapest, and then the next one in line is going to be a little more expensive, and then et cetera, so where the term structure slopes upwards like this, that's what we have most of the time. That's a bullish thing for stocks. Occasionally this happens, where the near-term options, near-term futures get the highest, and then a little less than that, and the term structure slopes downwards. And typically when that happens, VIX itself is way up here. So they're at a discount to VIX, and they're all sloping downwards. When that happens, you got plenty of trouble on your hands. And that's where we are right now. And the reason this is let's just say the market's going down, you're in a panic, you want to buy some puts. What do you buy? Do you go out and buy a 3-month put, even though its implied volatility might be, say, here, which is slightly lower than the 2-day put, which is here? Or do you just buy the cheapest dollar thing you can get your hands on for some protection? Yes, that's what you do. You buy this one. So this one is everybody's buying this one and forcing its price higher, and it trades with a higher implied volatility. It's really quite logical. And so here's the current status. This is last night's prices. So VIX is at 37.56. You can see the April futures are at 34.45. So 34.45 minus the price of VIX is a discount of $3.11. And now you can see each futures price is lower than its predecessor. So the term structure is sloping downwards like this, and they're all trading at discounts. You can't get more negative than this. So all the other stuff we've seen some oversold things and, whatever. I mean, people, I'm sure there'll be articles over the weekend like, oh yeah, these things are big discounts and, that's an oversold condition. And they go back and cite March of 2020 when there had these big discounts. And yeah, it was a buy signal. Yeah, it was a buy signal like a month later. And meanwhile, you got destroyed before the buy signal kicked in. So this will give a buy signal, but that's not the picture right there you want to buy into. That's a very bearish picture. Now, these CBOE publishes 6 volatility indices. Here they are: 1 day, 9 day, VIX is a 30 day. There's a 3-month, 6-month, etc. You can see these are all sloping downwards as well. So the term structure here, again, sloping downwards, very bearish. You can see there's a couple of things we use here as measures of oversold. One is that VIX is trading above the 3-month VIX. If that reverses and VIX falls back below the 3-month VIX, that's usually an indication the term structure is reverting from a negative sloping to positive sloping. And that's a buy signal. That's a short-term buy signal for the stock market. So that's one thing that could happen soon. I mean, quickly. I'm not saying it's setting up to happen. It's going to happen. Eventually, VIX is going to go back below the 3-month, no matter when. Another thing, too, the 9-day, forget the 1 day. That's used mostly for 0-day expiration trading. But the 9-day is higher than all the rest of them. That's another very extremely oversold condition. And when it falls back below any of them, that's also a short-term buy signal. So all we need to do is see the 9-day fall back below VIX, for example, and that would be another short-term buy signal for the stock market. So right now, this construct is very bearish. The April futures are going to expire next Wednesday. And so we've been watching April versus May. You can see here April is trading more than 5 points higher than May. That's very worrisome. Anything over like 1.5. And so, but you think, well, May, as soon as May expires, I'm just going to back up 2 slides. You can see though that May is trading above June too. So not that much, but not as much as April is above May. But when May gets to be the front month next Wednesday, then that's what people are going to be buying as the short-term option, and it could force that higher. Now, in reality, there are weekly options on VIX, and there used to be weekly futures. I mean, technically, there still are. They don't trade, which is a shame because if you really want to simulate what VIX is doing to your best extent, I don't like buying VIX calls that have more than 2 weeks to go. And so the last couple of weeks we've been able to buy the regular April expiration, which is where all the liquidity is, and fine. But now the May expiration date is May 20. I'm looking here. May 17th. So you got a whole month. That's too far out to buy VIX calls and expect. So if you buy, let's say you buy a May 30 call, and VIX goes to 80, you're not going to see May go to 80. It's not going to happen. But the 2-week one is going to do a much better job of going towards 80. So there's a strategy that we've used. We first used it in the financial crisis, then we used it in the pandemic and made a lot of money with it both times. We've tried using it other times when you've got these discounts, these negative term structures, and it hasn't always worked as well. But we did one last week, and it worked out really well in April. So now we've outlined one for May, and it's in the Option Strategist newsletter that we just published yesterday. And essentially, what you do is you buy 3 slightly in the money VIX calls, and you buy 1 slightly in the money SPY call, expiring on the same date or within a couple of days of each other. And the VIX expires on Wednesday, and sometimes there's not a Thursday or Wednesday expiration, and SPY, so just buy the Friday one. So we buy calls on both. So why that? Well, so first of all, we buy this. We only do this when there's a big discount. So in the, I just showed you that, May is trading. Hold on 1 second. So May was trading at 28.70, and VIX closed yesterday at 43, whatever. Oh, I'm sorry, 37.56. So it's a 9-point discount. So by May expiration, that discount has to disappear. Now, it doesn't necessarily mean that 28.70 is going to rise to meet here. This could fall to meet that, or even go lower, but discount would disappear. But we buy the VIX calls because that's where the discount is. We've got an edge because of the discount. But how do we protect ourselves? Well, we buy the SPY call, because if VIX is going down, SPY is typically going to be going up. So the last week, they both went up at different periods of time, but we roll them when they get in the money. As we do with everything. So the one we had on in April, the VIX calls first went up. We rolled those up. Then later in the week, SPY went way up. We rolled that up a couple of times. And so, that's the way we treat these. And if the discount disappears, if VIX and May get back to within a couple of points of each other, then we're out. So we set up this new May recommendation. I'm not going to go into it any deeper. The specifics are in the Option Strategist newsletter. If you are a subscriber, take a look. If you're not, I invite you to be a subscriber. I'm going to have a good offer for you here in a minute. Now, another thing that I don't usually show this chart, but because it doesn't come around too long, but we had 2 90% days last week. Well, on the Monday, when the market just absolutely got smothered, we had a 90% down day. There's two ways you can have a 90% day. You can have advances be 9 times, declines be 9 times advances, or declining volume be 9 times advancing volume. And then a 90% update, just the opposite. Advances 9 times declines, or advancing volume 9 times declining volume. So on Wednesday, and when we had the big rally, we had a 90% up day. So now this past week had a 90% down day and a 90% up day. If this persists, it's not good for the market. So you can see on this chart here, on the left hand, the scale is how many 90% days you had in the last 50 trading days. You can see in the financial crisis, it was crazy. You had like nearly half the days were 90% days, and then it happened again after the flash crash. In the pandemic, we got up to about 10 out of 50. Right now, we're 2, just those 2. So nothing too worrisome yet, but I'm going to start paying attention to this thing, because if it gets above this is 3, and I'm sorry, not sure. 2 is this is 2. Yeah, that's 3. So if it gets above 3, I'm going to start looking, because it hasn't been above 3 too many times recently without the market getting socked pretty good, and this one here in the end of the fall of 2015. That was a very bad market. That was, I think, the first time I ever saw the SPOOs open down 100 points. So something to pay attention to. Another thing that we've seen is the trading ranges are huge on this. So the true range, or I have percent true range, just as a side, the true range is measured by yesterday's close to either today's high or today's low. That's the true range. So it includes an overnight gap if one happens. So we have had true ranges of 300 and 400 points this week in the S&P. That's really crazy and not bullish at all. So where do we stand? Here's all these indicators. The only buy signal we had was VIX spike peak. That's on the left here, and so the only thing in our bullish column. We have one thing in the neutral column is we don't have a McMillan volatility band signal right now. We're waiting on a buy signal. Everything else is bearish, and they're oversold. The chart is bearish. These are oversold. This is not going to reverse anytime soon. The trend of VIX not going to reverse anytime soon. Put call ratios, those could give buy signals. So I moved this one a little off the margin just because it's probably the next closest to a buy signal. Then we have this construct of volatility derivatives that we just looked at, the downward sloping term structure. So pretty bearish and very oversold. So we're looking to buy, but not until we get confirmed buy signals. And so we've rolled down our bearish positions. I don't think we're putting on any new bearish positions right now because we haven't got any new sell signals either. But it's doesn't look like a bottom yet to me. And the thing I'm not saying we're going back below 48.50, and we can make a bottom without going clear back to there. But there's work to do before a real bottom is in. And it's a bear market. I mean, this could go on for a while. Bear markets don't usually just last 37 days. I mean, the one in March of 2020 did, but that was a little unusual, the pandemic. And, I don't know, is this one really based on tariffs, or were there other problems that just got exposed in a quick manner? I suppose if it was really just based on tariffs, and it could go away in 37 days as well. But we'll see. We'll get buy signals. I'm not worried. I've never been too concerned about finding the bottom. Not the exact bottom, that we don't do that. That's crazy stuff. But the real bottom, the trading bottom that's going to last for a while, we'll find it with these indicators. So just oversold, not a bottom. I just said that. We're holding a core bearish position. It's been rolled down, mostly negative indicators. And then most importantly, we keep rolling our puts or calls when they get in the money. It's just, it's a very psychologically pleasing thing to do. All right, so I mentioned this benefit or whatever sale. First of all, we'll send you the PDF of this presentation. I'll try to put in those other put call ratio charts. Recording will be made available to you as well. That's not the I'm sorry, what did I just do there? I don't know what I did. Okay, that URL is not the correct URL. You'll get the stuff emailed to you. You don't have to go online and find it. Anyways, so the deal is you pay $99, you get 1 month of each of these 3 newsletters. The Option Strategist comes out once a week. We've been publishing it for 34 years. There's a full track record on the website. We publish once a year. We go through and update, kind of everything that happened. The Daily Strategist also has a track record on the website. That comes out twice per day. There's a volatility report and a market report. That's our, premier product. A lot of serious traders use that. And then there's daily volume alerts. I write that myself every morning. That will have, all of these have all those indicators in them, but daily volume alerts probably has the most adherence to all of these indicators we talked about. And of course, even though they've been doing well, past performance is no guarantee of future results. So one thing we've been doing in TAS, and I hopefully these expensive options are not going to discourage this, is that back from 2016 to 2019, this was an extremely profitable strategy, was buying straddles right in front of earnings and then selling them up. But then it went away after the pandemic. Options got so expensive and blah, 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 whatever. It took really until the last couple of quarters for it to come back. But now it's come back with a vengeance. So we've actually bought straddles on all those stocks that listed there. Lulu was down huge. We didn't buy the ones on Real Tick, although they were on our list. You could have seen them on the list. And so next week, I think Netflix is coming up, and we're going to be buying straddles there. Now, it is a $900 stock, so there are some nuances to doing that, but you can buy out of the money strangles to try to lower your costs. You'll lower your risk as well. We have a new website. I invite you to come there and wander around. We have a YouTube channel with a weekly update of the market and a couple of other newsletters. But the special that we're offering is these 3 newsletters for $99. Just for fun, because I did a preview in the year of 2025. Just went back and looked at a couple of things we talked about then. These supposed January barometers. Well, first of all, the Santa Claus rally, that was the last 7, that overlaps the end of the year for 7 days. January early warning system, the first 5 days of the year, and the January barometer, first month of the year. So the Santa Claus rally was negative, and that that's a negative for the market. So that was actually something worth heeding. Yale Hirsch, who invented that indicator, had this saying, if Santa Claus should fail to call, bears may come to Broad and Wall. Well, they certainly did eventually this time. The early warning system, though, and the January barometer were both up. I mean, those are both predictions for the whole year. I don't see how this year ends on the plus side, but hey, things can happen. And the January seasonal is a trading indicator that we traded in January. That basically did nothing. Another thing was year's ending in 5 are supposed to be very big, although they haven't really done all that well in the last couple of years ending in 5. But back in the 20th century, they certainly did. Again, I think if this one ends where it looks like it's heading, I think that indicator's gone. And then finally, the presidential cycle. So in the first or second year of the president's term, the market usually goes down or has some problems, or that's when bear markets happen, what have you. It was the second year of Biden's term. This is the first year of Trump's. We didn't really have a bear market from 16, well, until the pandemic hit, but I think that was a different thing. In any case, this decline fits sort of within there. And usually then years 3 and 4 are very good. So just because the market's tanking right now, looking a little bit across the horizon, it could do very well once this panic ends. This same sort of thing. So one other thing I had shown in this chart of the sort of trend of volatility, and when we talked about it in January, the trend was rising, and you can see back there in 2021 and 2022, the trend was rising, eventually produced a bear market in stocks. Well, this is still a rising trend right now. So obviously VIX is very high. This is a composite implied volatility of stock options, but still same sort of thing. So when we get up here to a peak, and I'm not sure where that's going to be, but this will eventually peak out up in here. I lost my eventually it's going to peak out up here somewhere, and then a more longer term bullish trend can begin. And then just finally the graph of VIX on a yearly basis, we just took the average price for all those years from 89 to 2024, put it in here. You can see that typically VIX does rise into March. Well, now we're into April. And then it will begin to fall back towards the summer low in July. But then the fall is usually pretty crazy again. So we're not exactly in this pattern because by now it should be already declining. It's not. But, in general, this is the pattern we look for VIX. So that pretty much wraps it up. If you're interested in money management, go to the website at the bottom here, and you can. We're $100,000 minimum on our account management, our accounts that we manage. I'm going to see. Do we have any questions? Okay, so as the McMillan Volatility Band indicator available on TradingView. Yes, so you go to TradingView. I don't think you even have to be a subscriber of TradingView, but then you can sign up for our newsletter for the MVB as one of the premium signals that you can buy there. It says stocks only, high, low, close to S&P. So we don't really use those other new highs versus new lows, if that's what you're asking me. I use just the ones on the New York Stock Exchange, but the others are, we publish them, and then you can see they're in that chart. But that's, only stocks only, high, low, close to S&P. I'm not exactly sure what that question means, but in any case, I'm going to update those charts, the individual put call charts. If there's any of interest, I'll stick them in the PDF, and the PDF will be emailed to you as well as a link to the recording. So thanks for attending, and good luck in this market. Remember, oversold does not mean buy, but we will get some buy signals. We just don't have them yet, except for the one spike peak. All right, that will conclude the webinar.